Sometimes you may be sitting there, pulling your hair, staring at the profits and the losses on the screen, and are simply just flabbergasted in disbelief. You feel you have mastered all these great strategies, having soaked up all the education, books, seminars, tips, and above all, even risk management rules from all the reputable sources. You feel you have a system set up in a way that's as optimal as it can be, and you simply don't understand why the market is against you. Or, hopefully better, you actually don't really know why you made money when you made money. You may start feeling confused and don't know what to do when something happens. For example, this stock you're holding is going to the moon, and the profit, on paper, looks very gratifying. But then it falls like a rock. Now you are going through a slew of new market information, data, and all these different strategies in your head. But you simply don't know what to do, and you have all these mixed, complicated emotions, which often makes the decision making process even more inefficient and terribly painful. You may have heard of this, that most traders believe that the number one rule that makes a successful trader is you need to find a strategy that works for you. Or more specifically, you need to find something that works for your own psychological traits, that fits your personality, your innate tendencies, like the ways and preferences of how you make decisions in different scenarios. When things go well and you feel like you're cruising, when the market goes completely opposite of your outlook, and you may feel the universe conspires against you, or the scenario when the world seems to be in complete turmoil and there's simply just no clear direction. What works for other people may not work for you. And one of the primary reasons is that different people simply have different psychological traits. The goal of this short video is not to tell you everything about trading psychology, which no one can really claim to understand, but to introduce some rudimentary concepts, and hopefully to link them more directly to trading in particular, so that we know at least to some extent how to think about certain scenarios, and it may have just a little more clarity in the decision making process. Just like a strategy may work for some people but not the others, a certain psychological trait may be harmful in some scenarios, but actually beneficial in some other scenarios. In the end, you need to find something that works for you. We'll jump right into examples. We'll use the ARK Innovation ETF, ARKK, as an example, and go through a few possible trades. These are for demo purposes, of course, so not real trade recommendations. We'll start from February 2021. Here's a little pullback, and we'll enter when it comes back and breaks the previous high around $150. Here, it broke the previous high at around $153, and we enter with a long position. Going forward slowly, we see it continues to climb up, though with some volatility. Here it closes at $102, so our trade is now a losing trade, but it's still $2 above previous high, so we hold on and continue. Okay, so now ARKK drops to $143. Now your trade is $10 in the red. You start asking yourself, what should we do? Should we hold or should we get out? Let's say you believe in ARK and you expect or hope that it will bounce back from this little pullback, just like the one before our entry. Or you fear if you get out and realize the losses, you may miss the reversal and have to wait for the next opportunity to utilize your capital. So eventually, you decide to hold on to this losing trade. This is known to be part of the so-called disposition effect, the tendency to want to hold on to losing trades. Let's continue assuming we decide to keep our trade. We see it continues to drop. Here, it reaches the previous low. And we continue. Here, it reaches the low in December 2020. Now you tell yourself, this must be a support level. And we've already lost almost $30. So let's continue to hold unless it breaks this support. Okay, now it lost another $7. Now you tell yourself, oh no, I cannot take this anymore. Finally, let's get out. Looking back, our decision to hold on to the losing trades because our fear of realizing the loss or our hope for it bouncing back ironically results in even a larger loss. Holding on to losing trades due to fear of realizing losses or a hope of bouncing back is only half of the so-called disposition effect. We'll find another trade to demonstrate the other half. Now in May 2021, ARK has dropped to $104, and we expect a long entry opportunity to appear soon. The next day, we see from the candlestick bar, the buyers are pushing the price back up at close, even though the bears are still in charge at the open. But the close didn't pierce the middle of the previous bar, so we wait. Continue. Looks like it was a good decision. We waited, since the price continued to drop. Now we see a green bullish bar that closes above the previous open. This is a piercing pattern, and let's enter this trade with a long position at around $104. The next 2 weeks see the price rise to $111, so the trade is about $7 in the money. Seeing 2 down days, you start to ask yourself, we have already made $7. The upward trend seems to be ending, so maybe we should get out. In other words, we worry there may be a reversal and want to realize this gain before that happens. This tendency to exit trades with moderate gains is the other half of the so-called disposition effect. Continue. Looks like we made the right decision since the price dropped again. However, if we continue, we see that it was not even a pullback. The trend simply just continues. And we now miss the opportunity for a potentially much larger profit. In these 2 examples, our fear of realizing losses or hope for a price reversal have resulted in more losses or missed profits. Does that mean the disposition effect is always harmful? The best way to address this question is probably to investigate the opposite, the reverse disposition effect. The time is July 2021. Let's try to find an entry point. Here is another piercing pattern. It's a green bullish bar with the close higher than the mid of previous red bearish bar. We enter at around $117. Moving forward, it's a winning trade for the first 2 days. Now we have a down day. Remember earlier, if we are still affected by the disposition effect, we would want to get out already. But we fear the upward trend is going to continue, so we hold on. Now we have another down day, but our trade is still in the money, and this bearish bar closes closer to the open, so we continue to hold. Now the price has risen to $125. We are $8 in the money. The market looks very bullish. So instead of being affected by the disposition effect, we're going to keep our trade because we hope the trend will continue and we fear that we may miss the potentially much larger profit. In other words, we're holding on to our winning trade. But moving forward, now we're giving back all the paper money we made earlier. Here the price now dropped to $116. Our trade is now in the red by $1. The disposition effect will tell us to hold on because we shouldn't realize the loss, and the ARK may bounce back right away. But we are doing the opposite. So, because we worry the trend may continue, the downward trend, and this $1 losing trade may become a much worse trade. So, we get out of it. However, we see we are missing this big reversal because of the decision of exiting with that $1 loss. So that's the reverse disposition effect. Because of our fear of missing potentially very good profits or our hope of a continuing trend, we may give back all the profits we get, at least on paper. And because of our fear of a continuing trend and more losses, we may miss a price reversal unless we re-enter with some excessive trading. The disposition effect is an effect discovered in behavioral finance. It's the manifestation of the so-called loss aversion psychological trait. Humans are theorized to be hardwired to be loss averse due to asymmetric evolutionary pressure on losses and gains. Here, the trader places a greater weighting on the concern of losses than the pleasure from market gains. In other words, they're far more likely to assign a higher priority to avoid losses than making investment gains. In terms of trading, the hope for price bouncing back and the fear of a reversal would put the trader into the category of contrarian traders who tend to believe or hope that the market would just mean revert. Some people say loss aversion or the disposition effect is a psychological error. But looking at the opposite, the reverse disposition effect, it can be detrimental as well. When you hold on to winning trades or exit trades with moderate losses, you let hope or fear of a strong trend dictate your decision, which may result in giving back all the money you may have made and more, or missing a price reversal and recovering the paper losses. In terms of trading, this puts the trader into the category of trend followers. We have seen the disposition and the reverse disposition effects with a few examples above. Trading psychology is characterized primarily as the influence of fear, hope, greed, and regret, etc. Greed and hope tend to drive decisions that appear to be too risky, while fear and regret often drive decisions that appear to avoid risk and generate little returns. How to avoid being affected by these factors? There's no absolute answer. Just like the question, will the market be trending or will it be range bound? It is a question that's almost impossible to answer. The market will always have a great degree of randomness. Everything is possible. Trains can keep going. There can be a pullback after a moderate run. Markets can be range-bound in different time frames. Nothing is really a zero probability event. What's important is to find a system that works for you. The keyword here is you. And some general rules may be helpful, such as to use more systematic approaches that are more rule-based, and follow some strict risk management rules with discipline. Okay, hopefully you find this short video helpful. And next time when you think about trades, um, hopefully you may have a slightly different perspective. Trading psychology is obviously a very big topic, and I hope you are motivated to learn more about it after this. As always, thanks for watching, and I hope to see you next time.